Right now, there are over $2 trillion circulating in a market that didn't exist 20 years ago. It has no CEO, no headquarters, and its creator? A ghost. We call it Bitcoin, but the story of how we got here isn't just about line goes up. It's a 40-year war for the soul of money. Today, we're going from the secret basements of the 1980s cypherpunks to the global stage. This is the real history of cryptocurrency. Long before the 28 crash, a group of rebel cryptographers known as the Cypherpunks realized that if money stayed digital and centralized, privacy would die. In the 90s, legends like David Chaum tried Digicash, and Adam Back created Hashcash. They all had one problem: the double spend. If I send you a digital file of $1, what stops me from sending that same file to 10 other people? For decades, the only answer was a bank. Halloween night, 2008. While the world's banks were collapsing, an anonymous figure named Satoshi Nakamoto posted a 9-page paper to a mailing list. It proposed a blockchain, a ledger that everyone could see but no one could cheat. In 2010, the first crypto trade happened. 10,000 bitcoins for 2 pizzas. At today's prices, hundreds of millions of dollars. Crypto was out of the bottle. By 2015, books like The Age of Cryptocurrency warned Wall Street. The old guard was being challenged. If Bitcoin was digital gold, a young programmer named Vitalik Buterin realized the tech could be more. In 2015, he launched Ethereum, introducing smart contracts. Suddenly, we weren't just moving money, we were programming it. We entered the era of DeFi, NFTs, and 1,000% gains, and equally massive crashes. This wasn't just a tech trend anymore, it was a new branch of economics, according to Narayanan and friends. But for students of financial history, Nakamoto's 2008 paper was a mystery. Here's why. In financial history, necessity is the mother of invention. For example, back in 1171, Venice invented the bond market to solve a concrete problem: how to finance a war. In 1602, Dutch merchants had a problem: how to pay for long-range ships to Asia. They invented the world's first stock exchange in Amsterdam. Another example of financial innovation. In 1730, rice merchants in Osaka had a problem: how to match rice producers with traders, spreading risk to the ones willing to take it. They invented the world's first futures exchange in Osaka. And next, fast forward to 2008. Exactly what business problem did Nakamoto aim to solve? Even today, this is still unclear. Some salespeople claim that Bitcoin is a store of value. Really? After multiple 50% crashes? Others claim that Bitcoin is about payments. Really? Bitcoin is hard-coded to a maximum of 7 transactions per second, or TPS. Incumbents like Visa handle up to 56,000. In 2025, hedge fund billionaire Cliff Asness famously categorized Bitcoin into 2 use cases only. He saw no use cases aside from speculation and criminality. Today, many years after Nakamoto, crypto still feels like a hammer looking for a nail. Crypto adoption grows fast, and 500 million people own crypto worldwide today. But why? This table shows that the vast majority of crypto users are speculators. The second most popular use case is a hedge in high inflation countries. An interesting use case is remittances via crypto, which cost much less than the 5% charged by banks as international workers send money home. How many different cryptocurrencies exist today? As of early 2026, platforms like CoinMarketCap report upwards of 17,000 to 37 million different digital assets. The vast majority of these are dead coins, joke tokens, or projects with zero trading volume. This is sobering. If you bought any of these, you took a 100% loss. Now that crypto has been released in the wild and seems to morph into different use cases, do we dare predict where it is going? We do not. We agree with Brian Arthur. a pioneer of complexity science, who identified unpredictability as a core feature of technological change. What we do claim is simpler. If crypto ever takes a permanent and enduring hold in finance, it could as well be the first case in financial history in which necessity was not the mother of invention. Like tulips in the 1630s, crypto is zero yield. It pays no dividends, no interest, no rent. The vast majority of crypto buyers today are financial speculators, like tulips in the past. If you are a prudent investor today, look elsewhere to meet your financial goals. Leave crypto to those prepared to stomach a 50% crash or worse at any moment. But if you are an offshore worker looking to send some money home without paying rip-off banking fees, crypto does look interesting. Our verified sources are shown here. We encourage you to tell us if your interpretation is different, or if you'd like to suggest other verified sources. Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel and join our community of individual investors who strive to learn from the misfortunes of others to avoid similar fates.